The idea of retiring with no savings can feel like an impossible mountain to climb for many people. It is a common belief that if you did not start in your teens, then the battle for financial freedom is already lost. This is a mathematical misconception because retirement is not about how long you have worked, but about the gap between what you earn and what you spend. For example, a person who starts at age 40 and saves 50% of their income can reach independence in less than 20 years. This proves that your current bank balance is far less important than your future actions and discipline. You possess the ability to rewrite your financial story today if you are willing to adopt a new strategy. It is never too late to begin the journey toward a comfortable and secure future. If you are starting in your 20s with nothing in the bank, you have the greatest asset of all, which is time. Time allows the phenomenon of compound interest to do the heavy lifting for you, so that small amounts of money turn into fortunes. Imagine a 25-year-old who invests just $300 every month into a standard market index fund. By the time they reach 65, they would likely have over $1 million, even if they never increased their monthly contribution. This massive growth happens because the interest earned begins to earn interest of its own over many decades. Starting early means you do not have to work as hard later in life to achieve the same results. Take advantage of your youth by making consistent investments your top priority right now. Starting from zero in your 30s requires a shift in focus toward career growth and increasing your primary income. At this stage of life, you likely have more professional experience, which can be leveraged into a higher salary or better benefits. Consider a professional who spends their 30s aggressively pursuing promotions or switching to higher-paying industries to increase their investable surplus. By increasing your income while keeping your living expenses flat, you create a larger delta that can be poured into retirement accounts. This strategy allows you to make up for lost time by contributing larger absolute dollar amounts than you could have in your youth. Focusing on your earning power is the most effective way to accelerate your path when you start a decade late. Building a high-value skill set today will pay dividends for the rest of your life. When you reach your 40s with no savings, the priority must shift toward radical efficiency and the elimination of all consumer debt. Many people in this age bracket suffer from lifestyle creep, where their spending rises alongside their salary, which prevents any real wealth building. A person who decides to downsize their home or trade in a luxury vehicle for a more modest option can suddenly find thousands of extra dollars each month for their retirement fund. By removing the burden of high-interest debt, you stop the bleeding of your net worth and redirect that energy into growth. This phase is about making tough choices today to ensure that your future self is not living in poverty. Efficiency is the secret weapon that allows a middle-aged saver to catch up to those who started much earlier. Reducing your overhead now will create the freedom you desire later. Starting in your 50s means you are in the hyper-focus phase, where every financial decision must be calculated and deliberate. The government allows individuals over the age of 50 to make catch-up contributions to their retirement accounts, which is a massive advantage for late starters. For example, you can contribute thousands of additional dollars into a 401k or an IRA beyond the normal limits allowed for younger workers. This period requires a high savings rate and perhaps a move toward a more frugal lifestyle to maximize every remaining working year. While it may feel late, you still have 15 to 20 years of potential growth if you remain employed and disciplined. Using these catch-up provisions is the most effective way to build a significant nest egg in a short amount of time. To retire comfortably, you must understand the mechanics of the 4% rule, which serves as the ultimate goal for your savings. This rule suggests that you can safely withdraw 4% of your total investment portfolio in the first year of retirement and adjust for inflation thereafter without running out of money. If your annual expenses are $40,000, then you would need a portfolio of $1 million to sustain your lifestyle indefinitely. Understanding this number provides a clear target that removes the guesswork from your financial planning. When you know exactly how much you need to save, it becomes much easier to create a month-by-month plan to get there. This rule is the gold standard for retirement planning because it accounts for market volatility and the rising cost of living. Low-cost index funds and exchange-traded funds are the most reliable vehicles for building wealth when you are starting from zero. These investment tools allow you to own a small piece of hundreds of different companies, which provides instant diversification and lowers your overall risk. For instance, investing in an S&P 500 index fund gives you exposure to the largest and most successful corporations in the United States with almost no effort. These funds outperform the majority of professional money managers over the long term while charging very low fees. By keeping your costs low and your diversification high, you ensure that a larger portion of the market returns stays in your pocket. Simplicity and consistency in the stock market are the keys to long-term success. Real estate can serve as a powerful accelerator for your retirement savings because of the ability to use leverage. Leverage allows you to buy a high-value asset with a relatively small amount of your own money, while the tenant pays down the mortgage for you. If you purchase a rental property with a 20% down payment, you are essentially controlling a much larger asset that appreciates over time. This creates a source of monthly passive income that can supplement your other retirement accounts and provide a hedge against inflation. For a late starter, real estate can provide a faster route to a positive net worth than traditional savings alone. Real estate remains one of the most effective ways to build wealth through both monthly cash flow and long-term appreciation. Optimizing your tax strategy is one of the most overlooked aspects of retiring comfortably when starting late. Using tax-advantaged accounts like a Roth IRA or a 401k can save you hundreds of thousands of dollars in taxes over the course of your life. In a Roth account, you contribute after tax dollars, and then all of your growth and future withdrawals are completely tax-free. This is a massive benefit because it prevents the government from taking a large percentage of your nest egg when you need it most in your golden years. By choosing the right accounts today, you are essentially giving yourself a significant raise in the future. Understanding the difference between traditional and Roth accounts allows you to keep more of your hard-earned money working for you. Geographic arbitrage is a powerful strategy that involves moving to a location with a lower cost of living to make your savings last longer. Many people find that their retirement dreams are much more attainable if they move from a high-tax city to a more affordable region or even a different country. For example, a person who finds it impossible to retire in New York might live like royalty in a smaller town in the Midwest or a coastal city in Portugal. This move instantly reduces your biggest expenses such as housing and taxes, which lowers the total amount you need to save. Geographic arbitrage allows you to maintain or even improve your quality of life while spending significantly less money each month. It is a practical way to bridge the gap if your savings are not as large as you would like them to be. Creating additional streams of income through side hustles can significantly shorten your timeline to retirement. In the modern economy, there are endless opportunities to earn extra capital through freelance work or online businesses that require very little upfront investment. Someone who earns an extra $1,000 a month through a side project and invests all of it can add hundreds of thousands to their retirement fund over a decade. This extra capital acts as a catalyst that speeds up the compounding process and provides a safety net for your primary income. The more you can earn today, the less you will have to worry about the fluctuations of the market tomorrow. Investing your spare time into a profitable venture is a direct investment in your future freedom. Your physical health is a financial asset that is often ignored but plays a critical role in a comfortable retirement. Medical expenses are one of the largest costs for retirees, and failing to maintain your health can drain even the largest savings account very quickly. By investing in a healthy diet and regular exercise today, you are effectively reducing the likelihood of expensive chronic conditions in the future. For example, a person who stays active may avoid the need for expensive long-term care or daily medications that can cost thousands of dollars every year. Think of every healthy choice you make today as a deposit into a high-yield savings account for your future self. Protecting your body is just as important as protecting your portfolio when planning for the long term. The psychology of money is the most important factor in whether you will succeed or fail when starting your journey late in life. It is easy to feel discouraged by your past mistakes, or to feel overwhelmed by the distance you have to travel to reach your goals. However, those who maintain a positive mindset and focus on the progress they are making every day are much more likely to stay the course. Discipline is built through small wins and the realization that you are in control of your financial destiny regardless of your starting point. You must learn to ignore the noise of the market and stay focused on your personal plan to achieve lasting success. Mastery over your own behavior is the foundation upon which all wealth is built. Retiring comfortably starting with no savings is a challenge that requires a clear plan and a commitment to action. We have discussed how starting in your 20s gives you the power of time, and how your 30s should be focused on maximizing your earning potential. We explored how those in their 40s must cut lifestyle creep, and how those in their 50s can use catch-up contributions to bridge the gap. We also covered the importance of the 4% rule and the use of low-cost index funds and real estate to accelerate growth. By optimizing your taxes and considering geographic arbitrage, you can make your money go much further than you ever thought possible. Remember that your health and your mindset are just as vital as the numbers on your balance sheet. Please like this video and subscribe to our channel for more deep dives into financial education. Which stage of life are you currently in, and what is the biggest challenge you face in your retirement planning? Please share your thoughts in the comments so we can keep this conversation going. Thank you for watching, and we will see you in the next video.